This is the first part of chapter 9, risk and return. Okay, so we're going to be calculating about, we're going to be making calculations, of course. But we're going to be talking about risk and return, right? Um, Returns. We can make returns in dollars, we can make returns in percentage, right? How much money am I receiving against what percentage am I receiving, right? Dollar return. Well, two components, right? Capital gain or loss plus income. We talked about this in the previous chapter, right? If we buy Apple for $100 and we sell it for $110, we're making $10 in capital gains. If we buy Apple for $100 and we sell it for $90, we are losing $10, right? So it can be capital gains or capital losses. And then we also have an income component, which is our dividend coupon in case of our bonds. Now, if we want to know the percentage return, we divide everything by beginning value. Don't forget, beginning value always goes in the denominator, sorry. Beginning value will always go in the denominator in the lower part of the division. We want to compare everything we make with respect to how much money do we invest at the beginning. The money that we invest at the beginning is what matters to us. We want to know if we're making more or if we're losing with respect to the initial investment. So don't forget, beginning value is always going to go in the denominator. Now, a little bit of overall information. Historically, stocks have performed better than bonds and other types of assets, right? Now, the average is not representative of what every year brings to us, right? This is a little graph, just a sidebar about the average. Well, we're going to talk about the average in just a minute, so I'll skip that for just 1 minute, right? Stocks, bonds, T-bills, right? Stocks, long-term bonds, and T-bills. Theoretically, stocks need to give you a higher return than long-term treasury bonds, and finally T-bills, right? So you can see, well, that has been the case for a while. Not in the 2000s. Yeah, in the 2000s were bad years for the stock market, right? Dot-com bubble, the real estate bubble. But then things got a little better. This is too much. T-bills really, really low. Now, let me talk about the average. Sorry for this. But the average, we know that is basically, we add up all of the observations we have and divide by the number of observations. The purpose of the average is to give us an idea on what should we expect. If we picked a random number, we should expect to behave like the average, right? Now, that is accurate sometimes. It is not accurate sometimes. If we calculate our average income, let's say the class's average income, well, it's going to be a certain number. Let's say $60,000 a year. I'm making numbers up. Now, let's suppose we invite Bill Gates to the class and then we calculate our income. Well, chances are that the income after Bill Gates, the average is going to be way higher than before Bill Gates, right? Bill Gates has a very, very important effect on the class's income, right? So that's the thing about averages. We might have one or two observations that can make everything go bad, right? Now, going back to Bill Gates, we are going to talk about volatility, which is risk, right? Basically risk. Standard deviation is basically the major way in which we can calculate risk. Now, once I'm done with this PowerPoint slide, I'm going to show you a very brief Excel example on how to calculate all that, right? Standard deviation is basically the risk. That's the way we calculate it. We have each return. We subtract the average return from each return. We square it. We add them all up, then divide by n minus 1, and then take the square root, right? Excel can do that for us really quickly. So this is the, I think this is the standard deviation. Yes, because we're talking about risk. So you can see stocks have a very high risk, right? Standard deviation measures the average distance from every observation to the mean. How far away are individual observations from the mean? The higher the standard deviation, the riskier the asset, right? I'm going to show that to you in just a minute. There's another measure that is called the coefficient of variation. It can measure risk, right? So the coefficient of variation is basically we divide the standard deviation by our average return. This is how much risk are we willing to take in order to make a 1% return. So let me go to Excel, and we're going to be doing Excel. Okay, so couple of little formulas equal to average. So if we do this and then we select the section that we want to average, we got our answer, right? 1.6, I'm going to center everything. 1.6, it's equal to the sum of all this, and then we divide by 5. Now, I'm going to, what if we calculate the average of this? Well, if we calculate the average of those 5 observations, we have 1.6, right? Both of them have an average return of 1.6. Now, the difference is, this one, we always have 1.6, right? This one, we have some other numbers. So in order for us to determine the difference, we're going to calculate the standard deviation, STDEV.S. We always use .S. That is the standard deviation of the sample, right? As opposed to the standard deviation of the population. Hopefully that is something you learn in business statistics. The standard deviation .S for the first part is 5.63, for the second part is 0. Right? Coefficient of variation, standard deviation divided by the average. Okay, I need to cut some decimals, right? We don't need 100 decimals, we just need a couple, right? And this is going to be 0. Yes. So this number right here is very interesting, right? We have an average of 1.6, but we have a standard deviation of 5.63. This means that our returns here, yes, the mean is 1.6. The middle point out of all of those 5 is 1.6, but on average they're going to be 5.63 up or 5.63 down. That is a lot of variation, right? That is like a lot of variation. We pretty much, actually this is not a percentage, this should be a number, yes. We are decided to take 3.52 units of risk per every unit of return. Now, in this example right here, well, it's pretty straightforward, right? Let me give you another example. And let's say it was a 0.6%, 2.6%, 0.6%, 2.6%, and then 1.6%. And I calculate everything. Okay. Now, how is this example? Well, all of them have the same mean, right? Now, why is this standard deviation lower than this one? Well, if you see all of these numbers are relatively close to the average, right? These numbers are relatively close to 1.6, whereas these numbers are way far off from 1.6, right? In our third example, we take 0.63% risk for every unit of return. That's pretty decent, right? Whereas here we put 3.52. Now, here's a catch. If you want